even though you need less money for investing in new builds, as soon as you settle the property, the bank is going to require you to have 30% deposit on that particular property before you can invest in other properties. Welcome back, Leverage Addicts. It's Blandon here, back with another property investment theory. Today we're going to be tackling a question that a lot of investors have been thinking about, especially with this high interest rate environment, is whether or not they should consider a property investment when it's negative cash flow. It almost doesn't make sense because if you buy a business, you want to make sure that it makes money. So why would you pay more, borrow money, and buy this thing that's going to cost you more money every single week? Is there a proper method to justify this? Let's dive in and have a look. Picture this. Now, maybe you've been scrolling online on TradeMe, having a look at all the different types of properties you can buy at the moment. And when you crunch the numbers on your spreadsheet, you find that it just doesn't add up. And it's a legitimate concern because right now with interest rates sort of in the 6.5% for the short-term rates, not many properties are going to be cash flow positive. Even if you get something in the 8 or 9% yield, you might look at something that's neutral when you put 100% finance against it. So are there situations where it could still be a smart move? How should you think through this? How do you justify something that is not going to immediately pay you off? I think the first place we can start is look at alternative investments that people have invested in that are negative cash flow. And that is startup. These businesses often lose a ton of money for years and years before they turn a profit. Yet they can attract millions of investments. What are these people thinking about? Take Amazon, for example. It's been losing money for years and years, but eventually it became one of the most valuable company on earth. In the startup world, there's a principle called the Rule of 40. It's pretty simple. The investors are looking for a combination of the net cash flow and the growth of the company to be 40%. So if a company is losing 40% cash flow every single year, then you're looking for at least 80% growth year on year. Likewise, if it's losing 100% cash flow, then you need 180% in growth every single year. So how could you apply this in properties? Of course, property is a complete different beast. Unlike startup, properties are unlikely to go to $0, which makes properties inherently a lot less risk when compared to an investment like a startup. Consequently, you would expect a lower return as well. High risk, high reward. Lower risk, lower rewards. Simple. You do, however, get a better security. Therefore, properties is a bit more secure than startups. After analyzing hundreds and hundreds of investment properties over the years, I've come to believe that a rule of 20 is a reasonable application of this theory on negative cash flow properties. There is a little bit of method in the madness, and let me explain to you why. In the last 5 years, I've been running a lot of educational seminars, and we even have our own property formula workshop. Every single week, I review a property deal that one of our client or perhaps a veteran investor that is on the market have bought. We look at the numbers in the workshop and we analyze the good and the bad of the property. There are a lot of metrics that I use when I run these workshops. We look at the basics like gross yield to something like mortgage coverage, cash on cash return. And now I've been applying the rule of 20 in a lot of these deals. I've come to a conclusion where most of these properties that I would say are above average usually have a 20% overall return on equity. If you want to check out some of the case studies that we have on our property formula workshop, definitely check out the link in the description. We put in 20 of the deals that some of our mum and dad investors have bought recently, and you get to see the numbers on those deals in this PDF that you can download. So rule of 20, I'm going to give you an example and we're going to break down the numbers. Let's say you bought a 3-bedroom townhouse for $700,000 and you needed a 30% deposit, which is $210,000. After all expenses, you might be losing, say, $6,000 a year. Now, with a conservative capital gains of 5% because it's got a smaller piece of land, you're looking at $35,000 of capital gains on average per year. So let's calculate this. $35,000 minus your $6,000 in cash flow gives you a return of $29,000. That's the net gain, capital gains and cash flow. Now you calculate the return on your deposit, which is $210,000. It gives you around 13.8% in return on your deposit. which is a bit lower than the 20% that we're expecting. So unless this property have an X factor, we would just let it go and look for a better opportunity elsewhere. So a second example is a property in South Auckland with 650 square meter land. We can buy it for $700,000, including all of its renovation costs. Now the deposit at 30% is going to be $210,000, and we're going to have a negative cash flow of $1,500. Let's assume capital gains at 6%, slightly higher than our previous deal because it's got a bit more land. That equates to $42,000 a year. That's a net gain of $40,500, giving us a return on our deposit, which is $40,500 divided by $210,000 deposit. We have 19.2% return. Even though it's just slightly under the rule of 20, you might consider going ahead with this because it's got the future potential. The third example is this Hastings multi-income property that was sold recently on the market. Let's look at the cash flow. It's not a negative cash flow property if you were to put some deposit in, but we'll look at it as a comparison so that you know what you could potentially invest in. So this property was bought for $800,000 with a 30% deposit, $240,000. The cash flow after your rates, insurance, etc., you have $8,000 of positive cash flow. Now, let's say it's got a 5% capital gains only. You're looking at around $40,000 in capital gains a year. So $40,000 plus the $8,000, we've got $48,000 in total. You divide it by your deposit of $240,000, it gives you a 20% return. So it hits our rule of 20, perfect. This is something we can look to pursue. So some important consideration when you are looking at the rule of 20. The first thing you need to consider is that the equity that is leveraged. Some of you might say, hey, I might be buying this property at 100% finance. I'm not actually putting any deposit down. However, that's untrue because you're still putting the equity in your current property up as investment. So there's an opportunity cost, meaning if you use equity in this first property, you are not going to be able to buy another property. So regardless in your calculation, you should always use the 30% deposit rule or the current deposit that is required. You would want to consider this in a new build as well because even though you need less money for investing in new builds, as soon as you settle the property, the bank is going to require you to have 30% deposit on that particular property before you can invest in other properties. So you need to account for the opportunity costs. There are some limitations on this rule of 20 as well. So there are 3 key ones that I've identified, and I think you should consider them when you are calculating your returns. The first one is the improvement value, just like in the example that we showed you. If the property have some sort of development potential where you can maybe chop up the land, subdivide it, you can build another house, you can get rid of the original house and build 8, this is going to give you significantly higher return on your money in the future. But this is unrealized gains. So if you can get close to 20 and still have all of that good stuff in it, it could be a deal that you can consider. The second important part is the borrowing capacity. You can have 2 $700,000 property, but one of them will allow you to have a lot more borrowing than another one that might be a single income property. So if you've been watching our channel, you notice that we always talk about multi-income properties. The advantage with these is very simple because you are getting a higher cash flow, therefore the money that you can borrow from the bank is going to be more in the long run, and therefore you'll be able to have a higher leverage on your portfolio. The third is that capital gains is going to be hard for you to predict, and it's a very important piece that you need to add into this calculation. But I urge you to use some data within the calculation, so you can check out websites like CoreLogic and qv.co.nz. Not only will you be able to look at some capital gains on the overall New Zealand market, you'll be able to click on certain cities and see what kind of gains there have been on those cities. You'll be surprised because one of the most common misconception is that Auckland outpace a lot of these smaller cities, which is not the case when you look at the data. You can take the average and discount it slightly because we're in this market where there's a lot of fluctuation. So a closing thought, the rule of 20 could be a great tool for you when you are trying to think through whether or not to invest in the negative cash flow property. Because if you're just looking at the net income, you might not get the full story on what you're getting from the leverage and the capital gains. So when it comes to considering the overall investment, definitely look at all aspects, your cash flow, your capital gains, your capital improvements. And if you're serious about property investing and you want to learn more, you can definitely check out our masterclasses that are on our website. It's $37. It gives you a very good framework to start investing, or you want to change your portfolio to something that's going to give you more cash flow. You can also learn that in the masterclass. We also have the property formula workshop, which is made for somebody who's wanting a lot more details around property investing. And it's a skill set that you can keep for life. So definitely check it out if you want great long-term results. Lastly, if you just need somebody to coach you through the financing side of things, our mortgage advisors do strategy sessions for free. They can guide you through how you can build your portfolio in a sustainable way, where we can consider the finance as the foundation so that you can continue to grow over the years. If you listened up to this point, all I ask for is just one thing. If you enjoyed it, leave a comment. I love any feedback as well on how we can improve. And until next time, I'll see you guys in the next video.